the specific railroad cost of capital numbers, but I do want to make it sure the record is clear on behalf of all of those panelists. Some were giving you estimates of ranges. Some of those companies may apparently in other contexts have disclosed their cost of equity and cost of capital numbers, but I think what they were trying to say in a nice way is they are under restrictions because of Security Exchange Commission rules about disclosing that kind of a number here or anywhere else if it hasn't been disclosed to investors before. So please understand that and don't think that those witnesses were trying to hide the ball from you. Couple of points, if I may, just to start where you started this morning, Mr. Chairman. We have a lot of agreement here today, but I think, unfortunately, we may have some more disagreement that perhaps you said in your opening remarks, so let me see if I can flesh that thought out. First, on the CAP-M methodology, which you've proposed, that's why we're here, we now all know, and I think generally agree, there were some significant flaws in your original proposal. We don't say that to make anybody feel bad. That's the nature of a rulemaking, and it's an opportunity for the interested parties to examine and comment on proposals, and we have. So I think now we all realize on the risk-free rate that the experts agree that a 10 to 20-year T-bond is an appropriate input. On the beta, I think you're getting pretty close here in terms of some general agreements. I do think it's important to bear in mind what Professor Meyer's slide showed, or Dr. Stangel's slide, that beta in the last couple of years for the railroad industry has been increasing significantly. On the market-wide risk premium, which is the one that there is the most concern about, and Vice Chairman, you just expressed uneasiness, I think, about using a long period going back 1926 or even 1900, as some of the experts suggest, that perhaps isn't relevant to the experience of the rail industry or the economy in more recent periods. My response would be that the MRP is one of the components of this model. It's not something that we, in the abstract, we are recommending and suggesting. You have selected the model. That is a key component of the model, and I respectfully submit that the experts who have been here in front of you today and other experts that Professor Myers and Dr. Stangl have referred you to argue for a longer, much longer period of time than the 50 years you use. And I quickly would refer you, for example, to Professor Myers' statement in the AAR's opening comments on September 27, 2007, where he addresses this point at pages 9 and 10 and says it's very clear that given what all the experts who address this in the field say, that the 5.2 you originally proposed is too low. So I would urge you to take another look at that. Mr. Chairman, what I meant when I said there isn't as much agreement as perhaps you suggested, I think I heard you say in your opening remarks that there's general agreement among all the parties to abandon the discounted cash flow model. There is not, sir. There is not. We are not have not ardently defended the single stage DCF that the board has historically used, as we did perhaps at the outset of the proceeding. We do know how to read the election returns to some degree. We're reading the evidence that's come in. But I think you've heard here today, and I certainly hope you've gotten from our comments, and you will get from me now, the AAR's strong belief that a multi-stage DCF properly conceived and properly implemented is a key and must be a key component of what the board ultimately decides to adopt as its standard for determining the proper cost of equity, cost of capital. Unfortunately, I submit, and I think Professor Hodder said this twice in his remarks, this record does not contain sufficiently fleshed out and examined such a model. There have been discussions. We have put in evidence explaining why we, again, submit that the two-stage DCF that was used in your original notice and the DCF that Mr. Crowley, Mr. Fapp submitted are significantly erroneous and generate values that are far from where they ought to be in a properly implemented DCF. And that little slide that's up there now, just to get to something Dr. Stangl said I'd get to, simply depicts what the corrections, those two corrections that he talked about, to your DCF and to your DCF would do. Those are the corrections to eliminate the double discounting of years beyond the 21st year and to reflect the price appreciation from stock buybacks, not just stock dividends. Your 7.2 becomes 11.8. And the source for that, by the way, you can correlate this, is to the Ibbotson book that Dr. Stangl had here, the Cost of Capital Yearbook. I love that, which is publicly available. And that is the number they have for the current period. And I also put up there, since it was on the same page, the CAPM number they have for this current period, which is 11.1. And as an aside, Dr. Hodder said, you shouldn't pay any attention to Ibbotson because it's not just the 4 railroads. He said it's 8. I'm not an expert, he is, but I read the book, and I think it's 7, and they weight them, and the other 3 are the Kansas City Southern, the Genesee and Wyoming, and the Providence of Worcester. And I don't think the Genesee and Wyoming and the Providence of Worcester are going to have a big impact on the averages. So I hope you all do take a look at that. Transition. Again, there's been some discussion about transition here today. We think if you're going to go to the CAPM, or as we would advocate, a combination of a CAPM and a properly conceived and implemented multi-stage DCF, that you don't go there in 1 year. You've heard from a number of witnesses about the shock to them and the shock to investors if you had actually gone from what has been since 1982, a value of above 12% every year. That is, this agency, the ICC and the STB, have never found a cost of capital number below 12.8% since 1982. And in your proposed notice, which I understand, Mr. Chairman, is a proposal, it isn't a change, a final change. Nonetheless, when that proposal came out initially, it said 7.5 and then got corrected to 8.4. You could understand the basis for lots and lots of concern, not just at the railroads themselves, but among the investment community. We think those values, which are getting nearly half of what the DCF, the single stage DCF would have generated for that year, is just too big a jump. And if you're going to go to anything that brings the number down, which seems to be where this is heading, we certainly hope not as far down as 8.4. We think that you need to give strong consideration to a transition mechanism. And as I think Professor Myers said in his written comments for this hearing, the key is that you transition to a proper outcome at the end of the day, maybe less what the actual mechanism is. It's where you're going to get to when you're done transitioning. Mr. Chairman, you invoked this morning, it was Commissioner Mulvey invoked this morning a couple elements of the National Transportation Policy to kind of guide us here. I think you mentioned having accurate costs, for example, and fair, honest, and efficient management. And those are important templates and touchstones. I would like to remind the board, and I'm sure the board is mindful of it, that the NTP also charges you to permit rail carriers to earn adequate revenues and to foster sound economic conditions in transportation. We submit this supports choosing cost of equity and cost of capital values toward the upper range of the upper end of a range of CAPM values and DCF outcomes, and I think Professor Myers endorsed that point as well. And it may be one way to say this in the short form. I heard him say this yesterday. We were chatting about some of these things. The old adage of physicians, he says, sometimes applies to economists who are in a position to impact important outcomes like here, and that is, first of all, do no harm. And we really would hope that at the end of the day, no harm will be done, but that there will be an outcome that's appropriate for the rail industry and all of its stakeholders, including customers, including, importantly, customers of associations like WCTL. Which brings me to WCTL. Why are they here, and why are they so exercised about this, and why are they spending so much effort? I'd like to believe it's because they're interested in, truth, justice, and the American way, and it's very important to get things right. And on some levels, I'm sure that's true. But WCTL's members, as you well know, are large coal-burning electric utilities that pay rates to railroads to transport their coal. They bring rate cases. Those rate cases are significantly impacted by costs. Among those costs, importantly, are the cost of capital that we're here talking about today. If they convince you to adopt a methodology that results in lower costs of capital, lower costs overall, they're going to, they think, do better in rate cases. And frankly, depending on how far you go in that regard, you could actually be through this process expanding your jurisdiction by making more rates that today may not be subject to the 180 RBC threshold subject to it. I would hope that factor is given some consideration. I won't go into any detail on the replacement cost methodology. Message received. Railroad industry clearly understands it is incumbent upon it to come forward with a proposal for your consideration and the consideration of other stakeholders. All I can tell you is that is being looked at very seriously at the present time, and I think the industry will move as promptly as it's in a position to present you something that we think is useful and helpful, and not start the dance prematurely. A couple of times today, Mr. Chairman, I think you made the point, well, if we go to the replacement costs methodology, you would never replace all of your assets. I mean, who would ever do that? A lot of this stuff is old. It may not be used as much. Fair point, but I would say that at this point in time, as much as any point in the last 50 or more years in this country's history, more of the rail network is being utilized. More of the rail network, as you well know, is under great duress to be able to handle more and more traffic. So at this point in time, that problem might be a lot less than it would have been 10 years ago, and certainly well before staggers, given the great plant rationalizations that have taken place by all the major railroads over that period of time. So I don't think we ought to just kind of throw up our hands and say we can't try it. It's going to be a hard nut to crack, but I think we have to make the effort. Finally, nobody's talked about, and we're the lawyers, so I guess we're supposed to say a word about your last question about burden of proof, i.e. if whatever you pick here, if it's a CAP-M alone, or as we would hope and advocate, CAP-M with a properly conceived and executed multi-stage DCF, if in a given year one of the models generates an outcome or a value that appears for whatever reason to some stakeholders to be out of line with not only the other model, but with what they believe is the real cost of capital to market that year, what should be the standard for coming back here and asking you to take a look at that? Maybe that's off the table if you go to what Commissioner Mulvey was suggesting this morning. It might be a 5-year look back. But even if you have a 5-year, maybe look back isn't right, but a 5-year look, even in those circumstances, I would urge the board to consider including some kind of a provision for any parties, not just the railroads, to come in on a showing of reasonable evidence, substantial evidence, or conceivably material error, although material error implies to me that you did something wrong with the models, and I'm not sure that would be the source of a very different value. It might be something else going on. So a substantial evidence showing, and you can decide whether it is substantial and whether you're concerned, and perhaps if that happens, to give parties an opportunity to file evidence and try to convince you why you ought to do something different at that point in time. But I think you are focused on, and I think your constituents, railroad shippers and others, would appreciate as certain a methodology as we can get, as long as we always have the chance to raise our hand and say, we have a concern about what happened this year, can we talk about it? Thank you.
Sure. Thank you, Mr. Motes. We'll now turn to Mr. DeMichael. Welcome.
Thank you, Mr. Chairman. The National Industrial Transportation League, whom I represent, is pleased to comment on the methodology to be employed in determining the railroad industry's cost of capital, getting right to the bottom line. The League supports the board's proposal. We believe that the board has made a careful and thorough review of both the techniques used by other federal agencies as well as in the academic literature in coming to its conclusion that a single-stage DCF model should be abandoned and that the CAP-M procedures should be adopted. We think reliance on the analyses performed by the Federal Reserve Board is particularly very sound. We think that the board's CAP-M proposal appears to much more closely mirror the judgment of the nation's financial community with respect to the financial health of the nation's rail carriers than the prior single-stage DCF model. We agree with you, Mr. Chairman, that the comments in this proceeding indicate that there is wide agreement on the need for change and even agreement, we think, on many of the elements of the board's CAP-M proposal. Norfolk Southern, as they've repeated here, notes that CAP-M, in its comments, Norfolk Southern notes CAP-M is not an unreasonable choice and looks at its own cost of capital from a CAP-M perspective. AAR witness Hubbard states that in his comments he understands the STB's reluctance to continue its use of a single-stage DCF model, and witness Myers in his comments noted that CAP-M is a, quote, very useful methodology widely used in practice by corporations that estimate or update their cost of capital. In their comments, the AAR argues that the board should consider a range of estimates on the cost of equity and adopt a point estimate for each year within the upper to within the middle to upper portion of that range. I think that such an approach would enmesh the board in a continuing dispute as to where within the range the board should prescribe the cost of equity. We think there's really, when you get right down to it, no principled way of determining just where in the range this cost of equity should be set. I think the board should not shade its cost of capital determinations to achieve any particular result. Whether these fears or rate cases in the future or investment for this or that, we think, frankly, the boards should simply call balls and strikes here, try to get the number right, take a look at a well-supported methodology, take a careful look at the inputs that go into it, and come out with a rationally supported decision. Finally, we believe that the board's key technical choices regarding CAP-M are sound and supported by many of the comments. I'm not going to get into a lot of the technicalities. I think the experts have made many good comments on that, but just a couple of things. The board, I agree with Mr. Motes that the major disagreement here appears to be in the calculation of the market risk premium. The board has used a market risk premium of 5.2% for 2005 based upon data over a 50-year period. The AAR argues this period is too short, which allegedly biases the value downward. But if you look at the data provided by the AAR's own experts, it indicates that equity risk premiums have been dropping consistently for the past 25 years, and extension of the period back to 1926 would encompass very different financial conditions. Chairman Buckley, Vice President, that you've noted here, such as the Great Depression, World War II. You're looking back a long, long period of time. Significant that KCS's witness from the investment banking group at Morgan Stanley calculated the current cost of capital for KCS using a prospective market risk premium of only 4%, well below the board's market risk premium of 5.2. Finally, just a brief comment on the replacement cost. There is, as various people have noted here, a large number of disputes that would enmesh the board in a large number of very difficult judgments, including how to determine what existing investment would actually be replaced. And I think our view here is very similar to DOT, that the board, in using the current that the use of the existing investment base is sound. If you combine that with the replacement cost in standalone cost cases, it is a good balance. And we appreciate this opportunity to comment.
Thank you, Mr. DeMichael. We'll now turn to Mr. Rosenberg, who I know is glad to have the last word.
Absolutely. Thank you, Honor, and thank you, other members of the board, for this opportunity to appear before you to address the railroad industry cost of capital. I don't think I can speak as quickly and cover as much ground as the AAR's counsel, but there are some points I want to try and respond to, if I may. First of all, I had thought that it had been clear that there was no support for the single-stage DCF model that the board and the predecessor commission have used in the past. Hearing the most recent comments, I'm not quite so sure. I would point out that for 2006, the AAR proposed I believe it was a 13.8% overall cost of capital. That's not the cost of equity. That's the overall cost of capital. That is even beyond the range of the cost of equity that the railroad witnesses, representatives, were able to specify, and they also were not terribly clear exactly where it comes from, how it's defined, to what extent tax benefits may or may not be factored into that. I think it should be clear that the 13.8% and that methodology is not worthy of further consideration. What the railroads seem to be having now as their fallback is the Ibbotson three-stage DCF model that produces a higher figure, but essentially what it does is it takes the 5-year growth and assumes that it will continue for 10 years. I believe that the figure that's currently being used is 15.19%. That's even higher than what the AAR's 13.8% used for its 5-year growth rate. I think Mr. Motes also referred to whether or not there were 8 or 7 railroads. There were 8 railroads as of I think June of this year. Pioneer dropped out. Pioneer is now trading in the pink sheets. So that should give you some indication of the lack of transparency and the issues associated with the Ibbotson approach. Also, we would agree that the 5.2% equity risk premium that the board had calculated is reasonable. In fact, it was viewed as on a prospective basis, which is what makes sense if we're valuing things for an investor today. It's probably on the high side. One thing that was in Mr. Motes' written testimony. I don't think that he had time to get to it, but he had talked about the various rates of return on equity calculated for electric utilities, including Western Coal Traffic League members. And if you look at that, it shows that for 2005 for electric utilities, I think the figure, as I recall, was about 10.75%. However, it's important to keep in mind that that reflects an equity cap ratio of 56.73%. And I'll spare you the details, unless, of course, you want to get into them later. But if you take that and if you unlever the beta and then lever it back to reflect the railroad's capital structure, the cost of equity that you'll come up with is 8.47%, which is virtually spot on with what the board calculated in its notice of proposed rulemaking. So from our perspective, we would submit that the board's calculation is not only in the ballpark, it's pretty much at home plate. Also, he referred to the national transportation policy, and I believe it says that the railroad's returns ought to be adequate, and that's adequate and not more than adequate. Anything more than adequate amounts to a subsidy, and it'll come at the expense of the customers whose rates are subject to regulation, or at least potentially subject to regulation. In that regard, it's worth highlighting that most of the railroad's traffic is not subject to regulation, and while lowering the cost of equity would presumably lower the jurisdictional threshold somewhat, it still leaves the bulk of the traffic not subject to regulation, and thus these concerns that finding railroads, some of the railroads, perhaps all of the four major railroads, soon to be revenue adequate, would not suddenly impose a cap on their overall earnings. Also, some of the speakers, particularly for the railroads, have spoken of the need to avoid an abrupt change in the cost of equity and the cost of capital. They were pretty silent when the cost of capital went up from 10.1 to 12.2% in 2005, and they had no problems at all with with cost of capital going up from 12.2% to a proposed 13.8% for 2006. So this concern with abrupt change seems to be a door that swings only one way. Give me one moment, and maybe I can end a little bit early for you. I'd also note that the railroads have been rather belated. Well, I guess I also wanted to comment that the AIR Council said that Dr. Hodder had supposedly criticized the Crowley-FAP DCF methodology. I think that was more concurring with the technical errors in the board's two-stage DCF as opposed to what Mr. Crowley and Mr. Fapp prepared, and indeed Dr. Hodder back in December of 2005 in his written testimony put forth various examples of a somewhat similar multi-stage DCF analysis. So that's something that has been on the table for quite some time, and it seems in various respects that the railroads approach and tactics has been to protract this proceeding and to reveal their position slowly and to indicate that there's additional study that's needed. We submit that this matter has gone on for for too long, and something constructive needs to be done shortly, and a party should not be rewarded for tactics of delay. And then in terms of speaking of delay, that seems like a good point for me to conclude, and thank you all for the opportunity to appear before you.
Thank you, Mr. Rosenberg. I will defer to Commissioner Mulvey to start off with questions if you'd like.